Gabriella, what's your outlook for U.S. equities for the rest of this year? Could there be quite a lot of short-term bumpiness?
So I think most recently we've been focusing on some of the good news, the fact that we started to see some better data in terms of daily new infections, so lowering the risk of a nationwide shutdown and a double-dip recession. We've been focusing also on the earnings season and how expectations were pretty low, and the reality has proven to be less bad than feared. I do think there is this underlying assumption, though, that policymakers will not make an unforced error. And I think that's true on the Fed side. I don't know about the fiscal side. And I think that's the potential that's lurking beneath the surface for a little bit of volatility, unless we actually finally see an agreement. And I hope that, it's clear that the improvement that we've been seeing over the past few months has not just been mechanically reopening the economy. It has been the fact that all of this fiscal support has filled the hole that has been left by the pandemic. So we still have a double-digit unemployment rate. It's really important to get more enhanced unemployment benefits, to get maybe more stimulus checks so that we can continue with this recovery. So that's really, to me, the potential for volatility is on that fiscal assumption.
Why do you think we haven't seen, Stephanie, more volatility on the fact that, now we're looking at a deal being postponed potentially till September, if that, with those unemployment and benefit bumps fading and a potential hit to GDP?
Because there is no alternative, Sarah, truly, right? Look at the bond market. We were just talking about yields with a 10-year at 70 basis points. I mean, and the bond market, obviously, people got crowded into it. So are there really returns there to be had? And so I think you're seeing people look at other opportunities. They're looking at gold for sure, but they're looking at equities with dividends, dividend yields, dividend growth, strong balance sheets, and you have this massive amount of liquidity. I know we all want this another fiscal round, and I do again expect that we're going to get it, but you still have a tremendous amount of liquidity in the system. Again, it's 44% of U.S. GDP. Back in November of 2008, the last crisis, it was 5%. That's enormous. 30% M2 growth. So I think that is just too hard to fight. And so we can debate on what you want to own, growth, value, or whatever. But I think that you want to find companies that have good balance sheets, good market share, good free cash flow. And so you can get yield as well in that kind of an environment.
Mike, does the market want a weaker dollar or it to sort of tread water for a bit and plateau?
It has generally preferred a weaker dollar, at least in the sense that it was feeding the strength in the biggest stocks in the market, in the big secular growth stocks. I don't think, in general, the market likes disorderly, sudden moves of any magnitude out of a range necessarily. So that's I think the disclaimer on that. You wouldn't want it to keep shuttling lower. But in general, it's been the weaker dollar has been consistent with the market staying well supported. But this is a back and forth relationship as well. It's not something that is always true in all moments.